Hello and welcome to the DIY Investing YouTube channel. We are working through every company S&P 500, and today is Digital Realty Trust, ticker DLR. Over the next few minutes, I'll discuss my thoughts about business quality and its valuation. First up, this company has a market cap of $28 billion and an enterprise value of $41 billion. So we can see about $13 billion in net debt on this business, which makes sense because it is an equity real estate investment trust, or a REIT. REITs invest primarily in real estate, and so the real estate is usually highly leveraged, and that's what you see with this big net debt number. So Digital Realty supports the world's leading enterprise and service providers by providing full spectrum data center, co-location, interconnection solutions. It's an interesting business. So gives access to connected communities, has 284 facilities, 48 metros. So data center architecture, that's a very interesting REIT business. Never heard of one like that before. So what's also really good is you see a beta of 0.324. When you see a beta of 1, that means it's going to be just as volatile as the rest of the S&P 500. But when you see a beta of 0.3, that means it's going to be 70% less volatile, or in this case, 68% less volatile than the standard S&P 500 company, which tends to be a sign of a quality business. You like to see that. And when I see a number below 0.5, it particularly hits my eye that that's something to be paying attention to. Now, return on invested capital chart's very important because it can tell us about both the profitability of business and its general returns that they are earning. And the first thing I see here is there's not a single year of losses in the last 20 years. That's another sign of a high quality business. You have 20 straight years of profits here. Something is off with the 2002 number, but basically we're assuming this is all profitability years. And so you have 20 straight years of profitability, no losses, a very strong sign for a high performing business. Now, you do see the returns steadily improve over time from 2004 up to 2013. Now, what's downside is this return on invested capital is quite low. You start at 1%, you get up to about 3%, and they've been fairly decent. They've been fairly similar numbers, 2 or 3% for most last decade, 1% during 2020, 1% for 2017 and 2018, but 5% over last year. So what's probably happening is their most recent year numbers look really, really good, but this is a big jump from the previous year, so you have to kind of understand, is this a sustainable number? It's not always clear that way. But overall, what I don't like is that you spend the entire time below a return on invested capital of 5%. This is likely due to the high expense of real estate. A lot of times real estate is capitalized at pretty low numbers based upon the previous interest rates that you would see during this time. So it's not totally surprising, but these are still really low numbers for the capital. So that's going to be a limit on your performance. You're going to need debt in order to get higher returns than that as an equity shareholder. You do see this when you get to 10-year median returns. You have return on assets 2.6%. That converts into a 6.2% return on equity. So you're basically doubling, a little more than doubling your return on assets to get up to a return on equity. But it doesn't get you to double digits. I'd really want to see this number above 10% for me as an equity investor, because that's what would drive my return. My returns over the long haul are going to be capped most of the time by my returns on invested capital. And so your lower end of your return might be your earnings yield, which in this case is 4.5% to 5%. And then your upper limit's going to be kind of your return on equity of 6%. Now, incremental equity returns is all that matters, and the incremental returns on equity over the last year are probably really, really good. Anything that can allow this to triple is going to look really, really good. But the only way you're able to earn this revenue, asset, and EPS growth is if one of two things is happening. Your incremental returns are substantially better than your past returns, or you're having to distribute additional debt and additional equity in order to grow. This growth cannot be supported based upon the existing returns on equity. So we're likely to see both dilution and growing debt over time. And the problem is although you can grow equity consistently forever, you certainly can't grow debt forever. At some point, it won't be able to be serviced. Now you see decent gross profit margins, pretty good free cash flow and pre-tax income margins. Everything here looks pretty good. But I do have concerns on these returns on equity. Now, what you can see is that even though you've been profitable every year, you're not necessarily going up in a straight line. Now, some of this might be due to non-operating items, because we see that in terms of the actual operating profit, it seldom goes down. So something is happening on the non-operating line, because 376, 385, 378. So even though you had a 50% drop in EPS this year, that's not necessarily applicable for understanding what the business is doing. It's a lot more stable than what it's showing up on the bottom line. And that's actually a really good thing for investors. Dividend growth, you can see here kind of in line with what I'm saying on this for 10-year median returns. Return on equity, 6%. So your average dividend growth over the last decades, not much more than 6.2%. You have a few, you have 7.4, 6.8, 6.4, but then you have 2 years of 2.4, 3.5, and then 5.7, 8.6. If you average this across the decade, I would bet it's a little less than the 6.2%, and that's really driving your overall distributable cash flow. You also see that they're distributing a lot more dividends per share than they do earnings per share, which is normally a big red flag. So something weird is happening here with their cash flow, which we're going to have to look at in more depth. If you're enjoying this video so far, please hit that like button. Don't forget to subscribe. Your subscriptions help to drive the growth of this channel. Your likes let YouTube know that you're enjoying this content. So please hit that like button. And at the end of the video, I will have a link to the full playlist where I've already covered more than 130 of these S&P 500 companies. Now let's go to the income statement. So if I'm right here, you're going to have some other non-operating pieces, and that's exactly what we have. Remember, when I was looking at operating profit in 2012 to 2014, we talked about how the stability was here. And the reason the pre-tax number went up so much is because in 2013, they had a non-operating income number that's one time. So the volatility in the business is much less than it looks like on a bottom line basis, because you're getting some non-operating income on a periodic basis. Pretty regularly too, but it does jump around a bit. What is nice is that you don't have a lot of negative numbers here. So that is helpful to you. But you can see some big pieces, and probably what that is selling of real estate. If I had to guess, that's what this is selling some of the real estate and buying additional real estate. But what did I tell you about dilution? You've gone from 116 million shares outstanding to 283 million shares outstanding. So you've over 50% of your ownership in the business has been diluted. That means that if you owned 10% of the business at the beginning of 2012, you would probably own only 4% of the business or less in 2022. So that's a big concern. You've lost over half your investment, 60% of your investment, simply due to the dilution of the business. Now, you're earning more money. EPS has tripled over the course of the decade. So you've gone, if you take that down, that's what we say. We went from 10% down to 4%. If you triple that to 12%, you made money, but you were massively diluted in the process. If the company had a higher return on equity, then they wouldn't have had to dilute you, and your returns would have actually been a triple. Simply without any multiple expansion on this, but you probably need multiple expansion to justify this company because of what we're seeing here in this massive amount of dilution. This dilution is paying for the growth. Without this dilution, you can't have this growth. And that's what I really want you to understand with these numbers. You can't get revenue and asset growth and EPS growth when these are your median returns. It doesn't work. The math doesn't work. You need to be able to have a return on equity, or at a minimum a return on assets. One of these two needs to be high enough to be able to self-fund. And if you can't self-fund, then you're going to use debt or equity or both. And this company is definitely going to be using both, which we will see on the balance sheet. You can see they start out the decade with no goodwill. So that's been a piece. They've been starting to do some acquisitions here, in addition to some intangible assets. But I think long-term debt's going to tell the story, and that is exactly right. You have $2.6 billion in long-term debt at the beginning of the decade. You end with $13 billion in long-term debt, so you 4x'd your debt over the course of the decade, and that's driven everything. This is the growth. Yes, you tripled your earnings, but you 4x'd your debt, and that's where things start to get in trouble, because you can't do that forever. And as interest rates start to rise, this company could get in trouble. Let's look at the cash flow statement. Yeah, you can see these acquisitions here, which are taking place. Dividends are high. So dividends are high, but they're not higher than cash flow, but they're higher than earnings. And what you're basically doing is this is a very leveraged buyout type technique, is they're using the depreciation on the real estate to fund a higher dividend than they can justify based upon simply their earnings. If you were to retain some of these dividends, then they wouldn't have to grow as much debt. They wouldn't have to issue as much stock, and that could really help them in terms of getting your returns to shareholders being a little better. But again, without some financial shenanigans, you're going to be capped at this 6% return. So for me, 6% simply insufficient. Now, I do think what they're showing in the most recent years is that your future might be better than that. And certainly if cap rates go up because interest rates are going up, then your returns could get better over time as well, but your existing portfolio might take a hit. So something to be aware of if you want to invest in Digital Realty Trust Company. It's not going to go on my watch list because this median return on equity is simply too low. I need this to be in the 15% range, and we're less than half that. If you enjoyed this video, hit that like button. Don't forget to subscribe, and don't forget to check out the playlist at the top here showing you a link to the 130 S&P 500 companies I have already covered. So if you enjoyed this type of software and you want to do it yourself, check out quickfs.net. The first link in the description below is my affiliate link to QuickFS. This is the tool I use to analyze companies in 5 to 10 minutes, and I think you would really enjoy it. If you sign up using that link, I would get a commission for sending you to them, but this is certainly the product that I like most when doing my initial stock analysis. Thank you for listening, and until next time, stop paying fees, start building wealth.